Question comes up many times in the process of privatized banking. How do I ensure that the funds I'm setting up and all the premium payments I'm making, how do I ensure that that remains non-taxable? Because one of the chief strategies for privatizing money is to have money that's set aside and is growing, accumulating, cash flowing through a combination of withdrawals to basis and policy loans. You know, how do I ensure that that whole process legally avoids taxation? Okay, so this is an important facet of the privatized banking strategy. So I want you to write down or keep in mind two IRS codes. These are codes 7702 and 101. Both of those IRS codes address this issue of how the cash value accumulation inside of a life insurance policy is taxed. So those are important for you as a client to know. So here's the premise. Prior to the mid-1980s and what was called the Tax Reform Act. So prior to that, a client could take a lump sum of cash, they could deposit that into a life insurance policy at one time, so they could make one payment, and that amount of cash going in that account would then continue to build the base guaranteed interest rate. On top of that, the non-guaranteed dividend year after year, and would maintain its tax-favored or really tax-free status. So this was a huge way that clients could set aside money. Now, one of their goals in doing this was to have their cost of insurance, or the COI, that cost of insurance, to be low. Okay, well, they did that by having a low face amount or a low death benefit, the same thing. Those two phrases are used interchangeably. So they would have a low face amount, and then they would have high premiums, or they'd put a lot of money into the account. So the relationship looked like this. The face amount, very, very low, but the premiums, very, very high. Okay, so that allowed maximum cash value accumulation inside of the policy, retained all the tax-favored benefits. The IRS became wise to that and realized there was a massive tax base there that they were not taking advantage of. So in the Tax Reform Act that occurred in the mid-80s, I'd have to look up the exact date, but you can look it up. But when that happened, it changed this into something called a modified endowment contract. Modified endowment contract. Now, what that means is this is looked at the same way an investment is looked at. And remember, if you've seen any of my videos, I've told you that this IBC, the infinite banking concept, or privatized banking, is not an investment. Okay, that's not what this is. However, if you violate that limit, that modified endowment contract limit, it becomes taxable for the rest of the contract. Okay, there's no way to undo it or reverse it or get out of it. So we want to avoid that in most cases in the privatized banking space. So how do you do that? Well, we normally set, if let's just draw an imaginary line right here. If this is the M.E.C limit right here, then we normally want your premiums to go right up to that, but not cross it. So we want to stay right at that M.E.C limit, but not go above it. So if something happens and we get an alert that this policy is in jeopardy of becoming a modified endowment contract, that happens from time to time. It's nothing to be concerned about, but you do have to address it and to correct it, because of course we don't want to pay taxes the majority of the time when we set these up. So what do we do then? Well, you've got, let me back up for just a second and explain how the modified endowment contract limits are arrived at. It goes off of the age of the individual. So it would take your age, your sex, male or female, your health, your smoker status, whether or not you smoke. It would look at all those different things, right? And it would then arrive at what your cost per thousand, that these items determine how much you should have to pay per $1,000 worth of insurance. So you could receive a preferred rating, you could receive a standard rating, you could receive substandard or even rated, or in worst case scenario, it could be declined. So these items are used to determine what your cost of insurance is going to be per thousand, okay, those items. Then secondly, not only does it look at you and your health situation, your age, but it also looks at the face amount of the insurance. So the death benefit is what we're talking about here. So I'll write this out so you can connect these two in your mind going forward. We're talking about the death benefit. So this, along with this, then determines what that modified endowment contract limit is. And that's what's called a 7-pay limit. And 7-pay means 7 years. So the IRS uses this calculation, this algorithm, based upon how much premium can go into these policies at your age with your specific health condition and at that face amount. Okay, so that's really what it's needling down for. It's different for everyone for those reasons. So then it will come up with a number. And let's just say I'm going to pick a number. Let's say that number is an annual amount of $121,735. Okay, it will give you a very specific number. That is the 7-pay or the M.E.C limit. So then you have two choices. If you start getting close to where this could potentially become a modified endowment contract, there's two things you can do. Okay, number one, you can lower or reduce the face amount. So you not reduce it, but increase the face amount. So a higher face amount will then many times absorb that premium so it stays below that modified endowment contract limit. So I said that in a confusing way. Let me clarify for everyone watching. You need to increase the face amount or increase the death benefit that we're talking about. If you increase it, that many times will fix it. A second thing that you can do to fix it is you can decrease your premiums. So if you put a little bit less into it, many times that will fix it. So if you're bumping up against that modified endowment contract limit, or if you're actually in jeopardy of violating it, that's saying that there's too much premium going in for that specified death benefit for that individual's age and sex. Okay, so it's saying there's too much premium going in. We've got to back that down a little bit. So two ways that you can stop the modified endowment contract from happening are, number one, to increase the face amount, or number two, to decrease the premium. So if you've got a lot of premium that you want to sock away into one of these accounts, you've got those options, and you may need to open a second or third or fourth or fifth account. So most IBC clients have a system of policies. That system of policies is typically anywhere from 6 to 12 different policies that can be used for the purpose of banking. They can be segregated and specialized and used for a particular item, but they're separated out and they have an entire system that's kind of coordinated and working together. So that's how you prevent a modified endowment contract.